Kevin Zhou is the founder of crypto quant fund Galois Capital and former head of trading at Kraken. It's been a wild few days in crypto, and Kevin is here to help us get our heads around what the hell just happened. We saw Terra, one of the most prominent ecosystems in crypto, effectively disintegrate over less than a week. Its native token Luna had over 40 billion in market cap at its peak, and nearly all of it was wiped out, while UST, which was supposed to be a stablecoin worth $1, crashed. It was a historical moment in crypto, as never before had a project that big crashed so hard so quickly. Kevin was one of the few who saw it coming and predicted the fall just a couple of months ago. What were some of the red flags that helped him spot the fallout?
Yeah, so, I think, I first came across it, I at least studied it fairly carefully, sometime in 2021. At the time, it wasn't as big as it is today. I didn't think too much of it. I thought, it's just one of these, stable coins that probably just will never work out, but never paid too much attention to it. And then started revisiting it a lot more heavily in January of this year. And at this point, it had already blown up to such a big point. I mean, it was, I think at that point already a top 10 coin. At this point, I started getting a little bit scared. I think, before we've seen these kinds of algo stable coins collapse, and you have like, Basis, Basis Cash, Ampleforth, ESD, DSD, YAMS, the list goes on, right? And the latest one before Luna was Wonderland Time. And I remember being there for that collapse, and there was already quite a bit of financial contagion. It spread across multiple assets. There were these protocols that were composed on top of each other that owned each other's treasury assets, either directly or indirectly. Some of it was even farming on Anchor. That one we survived. I mean, we basically were able to get out of that one okay. But this next one, when I was looking at Luna, I thought, well, now that this thing is so big, this is an order of magnitude bigger than Wonderland Time. This could be absolutely devastating for the space. And, I think some of it was, some of me paying attention was also, of course, for profit too. I think there was a good shorting opportunity, and, I think there'd be a great play to be made there. But I think some of it also is that, this thing is so big, it affects everybody. And I think it's just important to, sound the alarm and spread the word. So that's when I really started very aggressively tweeting about it. And, it's around that time that, you have all these fanatics, these lunatics, in Terra, in the Luna ecosystem, and they're just like the XRP army. They're like the Link Marines. Everybody's rabidly defending and defending their protocol and attacking anybody who says anything negative about them. So, a lot of what I was saying was kind of getting drowned out because, nobody was, everybody's just like slinging mud all the time, and, had to weather a lot of, sticks and stones, slings and arrows during that period of time. But I think over time, I think eventually people started to see that, what me and I think a couple others, there was at least a handful of us, maybe 5 or 10 of us on Twitter who were really aggressively sounding the alarm. And I think finally crypto Twitter started listening a little bit more, opinions started getting changed. And then finally that plus, so that, basically the changing of the narrative, and then on top of that, the compounding effect of the equity markets completely crashing, just a couple of days ago, and crypto being super correlated to equities, also collapsing very strongly, kind of triggered this run on the bank, and that's basically how everything started. Equities crashed, the entire market crashed, and then basically when the market crashes, when we're looking at the mechanism of Luna and UST. Basically, as the market goes down, as the value of Luna goes down, then basically what backs the UST also goes down, because UST stays at the same market cap, but Luna is supposed to be backing it. So that's going down. And then all the external collateral that they had bought, the 3 billion that they had bought in Bitcoin, that also is losing value. So then people start to get scared. And at the same time, a tiny bit of money was starting to come out of Anchor from then the reduction of the yield from 19.5 to 18%. Well, it wasn't that much. That alone wouldn't have done it. A lot of these things alone, I don't think would have done it. But it's just a cacophony of these kinds of events, this coincidence of these kinds of events, and the stars aligned, and then they basically triggered a bank run. And once that started, it only fueled itself. It's like one of those things that just keeps getting bigger and bigger and spirals out of control. And then, basically now we're seeing hyperinflation with Luna, and everything has just been taken down. I think also some people might say, but what about, the rest of the markets? Well, I think a lot of what's going on is that, you have these large firms in crypto, and, some of them funds who are, maybe levered long Luna or levered short UST somewhere along the way or originally. But at some point they're just getting margin called as the price keeps dropping. And then they have to sell off all of their good assets, the non-toxic assets, to then basically cover their margin. And then some of them, they wound down their position. Maybe they were okay. They only took some damage, but some, they doubled down, right? And then they just keep selling all the good assets to double down in their position to support a bad asset. And then some of them are just going to get wiped out. So that's how, I think a lot of that contagion spread to the rest of the market, just from purely a mechanical standpoint. And then on top of that, there's also psychologically, as people are risking off, then people start wondering, oh, what other risks am I not seeing? Maybe Tether's going to depeg too. Maybe we should, short that thing. We should get out of Tether. Oh, maybe Ethereum's not as sound as I thought. Oh, maybe Solana or Avalanche is not as sound. So then widespread panic starts to spread. Maybe some of it even unwarranted, But when people start thinking about these massive losses are even possible from a top 10 coin, then people start getting really spooked, right? Because people have heard about a page 2 coin gecko, top 200 coin, maybe going to zero very quickly, right? But like this sharply, and for this high of a market cap coin to evaporate double digit billions worth of value in a couple of days, now everybody's spooked about everything, right? So that's also how I think, fear kind of fuels itself too.
Yeah, it was really so impressive to witness. I also think it was kind of seeing that a market cap flip between UST and Luna, that I remember being like, okay, like now this will really trigger even further losses, because it's like there's nothing there. There's just like not enough capital to back this. And then and now like with the huge kind of hyperinflation of Luna, it's like, well, it doesn't matter. You can you can print trillions of this, but if it's worth nothing, it's still kind of, never going to be enough, really.
Yeah, definitely is the case. And what I wanted to say is that the inflation is so bad right now in Luna that I think it's a step beyond hyperinflation. I think it's the hyperinflation of hyperinflation, as in hyperinflation itself is accelerating. And it's because as you mint Luna by burning UST, let's say the first clip, you have to mint 1 million Luna to do. Then the next clip, you have to mint 1 billion Luna to do. Next clip, you have to mint 1 trillion. Next clip, you have to mint a quadrillion. Soon, things really get out of control. So not only is there hyperinflation, but there's accelerating hyperinflation on top of that. So I think it's a very dangerous time. And I also think that, when you look at what happens at the very boundaries of all of this, right, which is that when Luna price is so compressed that it is now lower than a single tick above zero on an order book in an exchange, right? So like, for example, a tick might be, some exchanges use 1 penny as a tick, for example, right? So when Luna's value is below half a penny, technically it rounds down to zero, which means that there is no bid side liquidity whatsoever. It's a one-sided order book. There's only offers and there's no bids. Oh, wow. And at that point, even the UST, there's no longer even an incentive to inflate it further, because none of the UST can even get its own value of $1's worth of Luna. No matter how many trillions or quadrillions of Luna equals $1, there's no way for them to even monetize that to get back the value that they have in UST. So, that's basically one of the other things that I predicted, is that in the final death throes of the system, what's going to happen is that you're going to get price compression so bad on Luna that it's below a single tick bid side evaporates, and then everything left in UST is just bad debt. So everybody before that could actually come out and do this arbitrage where, you're basically getting the system itself still thinks that UST is worth $1. The underlying system still thinks it. So it'll give you $1 worth of Luna, right? But then eventually, once all bid side liquidity evaporates, then all of the rest of UST is just bad debt and it's worthless, basically. So, that's kind of what I'm seeing, because I saw earlier that, UST, is trading at many multiples of the market cap of Luna, right? And that's just for sure, there's going to be some bad debt in there. So it's almost a game of musical chairs to see who can exit out first. And then everybody left holds the bag to zero, basically, on UST. Right. And this happens when Luna liquidity evaporates. So, and I also wanted to kind of just rewind a little bit and talk about, something that you brought up, which was pretty interesting, which is you mentioned that there was a point during the crash, well before all of this, where the UST market cap flipped Luna's market cap. Right. And then it became very obvious that this thing probably was insolvent, right? And I think, the claims that I made, if you look at a lot of my earlier predictions and my tweets, the claims that I made were that Luna was very insolvent already before all of that. Even when Luna's market cap was 4x, even 5x that of UST's, it was already insolvent.
In what way?
Yeah, so I'll explain that a little bit. What I wanted to say is that it's just not obvious, right? So like when the market caps flip, then it becomes obvious. But it turns out, in my opinion, that even before that, it was already insolvent, even with very high Luna market cap. And the reason for this is because when you sell into an order book, into the bid side of an order book, you incur slippage, right? So like if you sell 1 million, you're going to get a certain price, maybe a little bit below fair market value. If you sell 1 billion, you're going to get much lower than the price than when you sold 1 million, right? So with each successive sell of UST into Luna, as you're unwinding, let's say $18 billion worth of UST, each successive sell compresses the Luna market cap by more than a factor of 1. It turns out, historically, now that we've seen this thing play out, my guess at the time was very generously, 3 to 5, medium generously, 5 to 8, and then a bit on the aggressive side, 8 to 10x on this kind of multiplier effect of selling assets down and how much it compresses the market cap, right? It turns out, historically, now that we've seen it play out, the rate was about 8 to 9. So it was about the 8 to 9 ratio, which was on the very more extreme, more dangerous side. But in any case, generally what that would mean is that you need 8 to 9x on Luna's market cap to sustain whatever UST's market cap is, right? So really the whole thing was just an illusion that there was solvency because they had created a giant supply sink for all the UST in Anchor, right, with the subsidized yields at 19.5%. So that's basically what my advocacy was. What I was saying isn't that just that Luna is insolvent. What I'm saying is that it was always insolvent, and it was insolvent by a lot. Even then, when Luna's price was in the high 80s, high hundreds, like it didn't matter. It was insolvent by a lot, and I think that's something that. I think a lot of people would probably think that I'm a bit more on the extreme side, but that was my opinion at the time.
So right now, I still see kind of UST has a market cap of about 4 billion. Does that mean, is that kind of like what holders are now stuck with? Is that kind of the losses that, investors have to just like write off?
Yeah. So what I would say is that Luna's price right now is still between 2 and 3 cents. So they can still get some money out, right? The amount that they're getting out becomes less and less over time. And eventually there's going to be some bad debt. How much total bad debt is left in the system? I would say hard to say. Right now, the market cap of UST is 4 billion, right? But that's at a price of UST of 31 cents. There's actually the amount of UST that's in the system is 11.7 billion of circulating supply, right? So like if that were $1, that's $11.7 billion. So out of where it should have been, how much bad debt is there? I would say at this point, probably $7 to $8 billion, maybe $8 to $9 billion of bad debt. I think at most they'll be able to get out maybe another $2 to $3 billion at most through the hyperinflation of Luna before complete bid side liquidity evaporates.
Oh my God, it's so tragic. I want to get your sense of who exactly are left holding the bag. Like, are these, retail investors who got in thinking that this was a saving instrument, that they were getting into something safe, a stablecoin, that they were pretty much guaranteed a 20% return? Or is it, more like a crypto, more savvy investor who maybe knew what they were getting into? Like, what's your sense?
Yeah, it's actually, I think from what I've seen at least and the rumors that I've heard, it's a mix of all of those folks. So, you definitely have folks on Twitter who are just, individuals, retail investors who, just say, oh, they lost everything, basically. They lost their mortgage, they lost other savings, very devastating. And then you also have funds and investors on the professional institutional side who will probably shut down from this event. There's going to be some that completely blew up, and there's going to be some that took on losses so big that they would not be able to continue their activities. So I think we're going to see how that shakes out pretty soon. But I've at least heard examples of multiple of both retail and institutional investors losing a lot of money. Wow.
It's interesting what you were mentioning before about the need to have, for the system to work, that you'd need to have a volatile token collateralizing the stable token with a market cap that is many times higher than that of the stable token. You were saying 8 to 9x times. So, if that had been the case, if Luna had been worth a lot more so that its market cap was a lot higher, could this thing have worked out? And I guess like the more general question is, do you think there is still hope for algorithmic stablecoins with maybe a modified type of design? Maybe if there was actual kind of underlying or more underlying demand for Luna or for the collateral asset? I don't know. Are there things that can be done, or would you completely kind of scrap this idea?
Yeah, so on your first point, I would say that instead of Luna market cap being a lot higher, what I would say is it would have been way better just to cap UST issuance, right? Mm-hmm. Like if UST only got issued out instead of to 19 billion, maybe if it was 10 billion or something like that, or 5 billion, maybe that would have been a lot more prudent, right? Because it's very hard to say how high Luna could have gotten, right? Like if the market conditions were right, or the feds didn't raise the interest rates or something. That's not something that the people in charge of TFL can really control. But you could have some kind of soft cap on the issuance itself, either hard cap or soft cap, cap it at 5 or 10 billion or something like that, or just even say that the cap is literally what the market cap of the volatile asset is divided by 8 or divided by 9, something like that, right? You could do it that way. Now, I don't want that experiment to happen because I'm sure there's other weaknesses. I generally tend to think, my opinion is that I just tend to think that generally these kinds of algorithmic stablecoins that basically are feedback mechanisms of these contraptions that contract and expand supply through some kind of mechanism. They're all the same, basically. When you reduce it down, at the end of the day, there's some point at which something causes it to contract because its price is too high, or causes it to inflate when the price is too high, and causes it to contract when the price is too low. It doesn't matter how many bells or whistles you attach to it. It doesn't matter how many feedback loops you go through, how many knobs and dials you turn to make that happen. Ultimately, that's basically the idea, right? And everything reduces down to that idea. So I just generally think that it can't work because effectively what's going on is that these guys are trying to play the Fed, but instead of having humans with economic models, they're using some kind of predetermined algorithm, right? And the Fed doesn't even work. I don't even think the Fed works, right? So how can this stuff work, right? When first of all, it's like the Fed, and the Fed doesn't work. And second of all, they can't force people to pay their taxes in their coin, and they can't force OPEC to trade oil in their coin. So like they're basically like a Fed with fiat money, but a very weak Fed with one arm tied behind their back, right? It like doesn't matter how if you do open market operations, doesn't matter if you replicate everything that the Fed does, it's just going to be worse because you don't have those two pillars, right? And even then, in the long run, I don't think the Fed works, right? So that's just that's what my thought is.
To swap crypto, a user has to choose among hundreds of DEXs on multiple networks, all offering different rates and fees. Do you want to avoid that hassle? Swap on 1inch, a DEX aggregator that gets you the best rates than any single DEX. Enjoy the unlimited liquidity across multiple networks and top-level security. Try 1inch now. When it comes to fiat currency like the US dollar, there is intrinsic demand propping up its value, stemming from trade, foreign countries borrowing in dollars and using dollars in their central bank reserves. Luna, the token backing the UST stablecoin, did not have such strong demand, and that ultimately led to its downfall. Can this mistake be corrected? Is there any hope for algorithmic stablecoins?
What I would say is that there is something to be said about the demand side, right? But as for the U.S. government, right, they're very powerful. They can throw their weight around. They can drive demand to dollar hegemony, right? With these coins, they don't quite have the military strength in order to do that. Now, this is a little bit bleak, but if you'll bear with me on a thought experiment, suppose at some point, one of these coins also founded a village in the physical world, right? And they had a complete military control as warlords over this community, and they forced everybody to use their coin. Then yeah, that would be sustained demand. And in that sense, they at least have one hand, half of a hand not behind their back when they had one hand behind their back, right? The other half is that you need it to be accepted in international commerce. So you need to be able to get other villages to accept your token and your coin for something in which everybody demands, something like oil, for example, right? That everybody would need, right? If you could do that within this community of villages, and then your village was able to do that, then your village probably could make an algo stablecoin work for some time, maybe 100 years or so.
Okay, that for all of that to happen, it's like so far-fetched that it's like, okay, probably not gonna happen. So what about other more decentralized stablecoins? Because some of the fallout that we've seen from this is a complete kind of loss of trust in obviously all algorithmic stablecoins, but as you mentioned before, even on Tether, which is at least partly backed by fiat, I've seen kind of DAI maintain its peg, but I also saw DAI supply really plunge in the past couple of days. So people are getting out of DAI, and DAI is collateralized and backed by digital assets. So to you, is there hope for a kind of more censorship resistant stablecoin, or is really kind of the only model that will work this over collateralized stablecoin, and even one that's backed by either over collateralized or just like backed one-to-one with fiat? Is that kind of the only way out? And if yes, like is there that would mean that there's not much hope for a truly kind of decentralized DeFi if kind of one of the core components is stablecoins, and if we will rely on fiat currency to back our stablecoins, then yeah, the system is not like very decentralized at its core.
Yeah, so I guess before I say anything there, I just want to say that I'm a big fan of decentralization. So I would very much like for there to be a truly decentralized stablecoin. But at the same time, I want to be realistic, and I don't want to just, through hopium, try to believe that a malconceived, contraption will work, right? And, in trying to be realistic about it, I just don't think that is possible. I think it's basically the analogy like the Fed. You can mimic open market operations. You can mimic control over interest rates. You can mimic all this stuff. I think it's just a bit too difficult. That being said, I think that even without a decentralized stablecoin, there are still some elements of DeFi which can work, and they can work in tandem with centralized stablecoins like Tether and USDC, and it can also work with other types of decentralized stablecoins like the make or die model, if it wasn't already so centralized and the backing is already so much, USDC, but something like that. Now, that's not very capital efficient because anytime you have to over collateralize, you're actually doing a lot of balance sheet contraction. You can't grow as fast, but it is more sound. And I think, of course, there are still risks there. And I wouldn't just say, oh, that's like the perfect model either, because, you still have black swan risks where if the price gaps, you could just be underwater on your collateral and you could just walk away from your collateral, right? So then there are situations where if the price drops too quickly, that people will walk away from their bad debt, and then the bad debt stays within the system, right? And then there's like ways of recovering it, but then, you have to print maker, there's all sorts of like stuff there. But then we start to enter into a world where a system has bad debt and needs to inflate a volatile asset away in order to, shore it up. But at least this is much more sound than a pure algorithmic stablecoin because you have that collateral there, and it really requires like a real like 3 sigma, 4 sigma event, maybe even 5 sigma event for something really bad to happen. And I think that probably should suffice, given that the holding period for holding stablecoins for a lot of use cases may not be super high, is that it's an intermediary, liquid intermediary between other assets that you want to hold. So I definitely think that there is still a lot of hope for, DeFi and some collateralized stablecoins, even slightly under collateralized stablecoins, I think maybe are okay. But not even close to the level that, we've seen with Luna and UST. It was the ratios were just way too off.
What about Tether? Because we did see it depeg a little bit. And I think from the NYAG investigation and other documents, I believe it's at about like 70% collateralized with, actually backed by fiat and I think other bank paper and so on. Do you think that's enough, or do you see? I mean, it seems like people were kind of losing trust in the level of collateralization that Tether has. I mean, do you think going forward that'll be an issue?
I think that it's mostly fine for now, but I want to caveat that and say that there's a lot of nuance to that, which is that first of all, if they're holding some stuff like corporate bonds, or like commercial paper or like dollar-like instruments, but that are not perfectly liquid like the dollar, then it's not, it may be taking on a little bit too much risk, and maybe it shouldn't be done that way. But what I would say is that that's still a lot safer than just backing it with like a completely volatile asset, right? At least these are more dollar-like as instruments. Now, that being said, what you could just consider this thing as, we don't have to call it a stable coin. We could just say that it's a basket of its underlying, right? So we could say that this is basically worth 60% cash, 20% corporate bonds, 20% commercial paper, and and that's basically what you're actually holding. Mm-hmm. And roughly most of the time it functions like it's a dollar, but intrinsically we understand that it's a basket of these 3 different assets, right? So that seems, perfectly fine as long as it's transparent that that's what this thing is, right? Now, if you want to call it a pure cashback stablecoin, well, then you got to back it with cash, right? But if you want to call it like a stable-ish coin that's, 99.99% just going to function like cash, but sometimes it may just completely just get wrecked, well, then you could call it it's just a basket, right? Yeah. So I think as long as there's transparency and the market has the option, then it's going to, different people are going to choose different things. Maybe you earn a little bit more interest when you have some commercial paper in there. I think all that's fine, right? So it's just whatever people want. Now, in Tether's case specifically, what I want to say is that I think they did a lot of shady stuff in the past, But that being said, I actually do think that they're fully backed, and I think they're actually over collateralized at this point, because one of the things that they did that they shouldn't have done is they actually went long Bitcoin using the funds that were supposed to be sitting in dollar, but they did it at a time when it was a bull market, so they accidentally made money and accidentally made it more than over collateralized. Now, maybe they pocketed most of the profits themselves, right? Maybe the Tether company pocketed most of the profits themselves, but I imagine that they would leave some extra buffer there just to make it a little bit extra collateralized, or not, or maybe they just left all of it in there, right? So that's one thing they really shouldn't have done. That was very shady of them, I think, to do, but they ended up getting lucky. These guys just keep getting lucky all the time, right? The other thing they shouldn't have done is they shouldn't have given their sister company, so they're both owned, the Tether and Bitfinex are both owned by iFinex, which is the holding company, and they shouldn't have given Bitfinex a loan for 800 million or something like that, right, way back in the day, right? Because Bitfinex got their money stuck in a scam called Crypto Capital, right? So they were short on customer deposits and they needed to shore that up. So they borrowed money from their sister company. This is completely taboo. This is completely incorrect. Definitely should not have done that. And then when they got caught, well, they dug themselves out of that hole again. They got lucky again, because then they're like, okay, we're going to do fundraising for Leo token. We're going to raise $1 billion, plug that hole, and then give back the money that we took from Tether back into Tether's coffers. So, technically, I think Tether should actually be whole right now, unless they've also done other crazy shit that we haven't discovered yet. For the most part, I actually think they're pretty well backed. But that being said, they need to cut out all the shady stuff. They need to stop doing the shady stuff. You know what I mean? That doesn't inspire confidence. The number one trade, there's two trades that TradFi people really love. The first one is to short Tether. That's like the first thing they do when they come into this space. Second thing they do, and this is back when the Grayscale trade was still alive, they like to do the Grayscale play, right? So those are the first two things anybody ever does from TradFi coming into crypto. So, I don't want to be the bearer of bad news. I don't think it's that great of a time to short Tether. I mean, should it be trading at 1? Well, maybe not. Maybe like 0.99, maybe 0.999. I don't know. But I think for the most part, I'm pretty comfortable with it right now. I'm not looking to particularly short Tether right now.
DYDX, the Decentralized Derivatives Exchange, is on a mission to build the world's leading crypto trading platform. To further this mission, the team is now developing the next version of the protocol, V4. DYDX V4 is planned to launch at the end of 2022, and it will be open source, fully decentralized, and entirely controlled by the community. To help power this next step, DYDX has launched a grants program with funding allocated to open source builders, contributors, and ecosystem integrations. Come build the future of decentralized trading at DYDX Grants. That's hilarious. First, you're totally right on the idea that it should trade more like a basket, and I think the key there is transparency. Like if we all knew exactly the things that Tether was holding, then the market would be a lot more efficient in pricing it, and it wouldn't be just like based off speculation like it was, in the past kind of few hours. And maybe you're right, like maybe they are like fully backed, but the real issue is that we can't know because there's not enough transparency, and we need to kind of rely on these like reports that they publish like every few months, and it's it's just not the right way of inspiring confidence in something that's really core to crypto. Like it's by far the largest stablecoin in the market. Like everything trades against it.
Yes.
And it's funny that you're right. Like it's been anticipated and predicted that Tether would be crypto's like black swan event, and that it would be the stablecoin that would drag everything down, and like maybe like crypto would end after Tether's collapse. But it just like keeps reviving and going, and then we have this like real black swan with Luna, and it like really did collapse and kind of actually almost got to zero in a couple of hours. So it's or days. So yeah, that all to say that it's incredibly hard to predict these things. Like you think like Tether's like the obvious black swan event, but then this other thing comes out of nowhere. Speaking of shorting, I as you were speaking before, I was wondering, were you short Luna when all this happened?
Yeah, so I can't comment on the specific positions of the trading desk right now because some of it is still active. So, happy to share that later on once the dust settles. But I will say this, which is that we have definitely been short through most of the crash. Not too big in size, but not too small in size.
Wow, interesting. Okay, yeah. Well, at least kind of it paid off to predict and see these red flags in Luna. I'll definitely want to follow up once the dust settles on kind of more details on that trade. Super interesting. Okay, so now that we're kind of in the middle of this, like what are some of the interesting ripple effects that you're already seeing in the market?
Yeah, I think mostly it's just you're seeing a lot of this like contagion spread to other assets, right? But I also wanted to say one thing that you mentioned, I thought, which is interesting about Tether, and I want to draw the comparison of like Tether to like USDC, for example, right? And as of right now, I personally trust USDC a little bit more than Tether. It's small. It's a little bit more. It's not a lot more. But maybe USDC should be at $1. Tether should be at 99, 0.999 or something like that. But a little bit more. And I think that the market trend has generally been in this direction, right? Way back in the day, Tether was completely dominant, and USDC was just a starting, new fledgling stablecoin. And now USDC is more than half of Tether's market cap. So clearly the market is also responding to the risks, but they're not responding through the price of Tether. They're responding through the supply of Tether relatively going down and the supply of USDC relatively going up, right? So what I imagine might happen at some point is that if almost all of the value starts migrating to USDC, there's some balancing equilibrium point in which you want to not have all of your stable coins in one basket, right? But if Tether was only 1/10 the market cap of USDC, I feel like more people would then want to hold Tether just to kind of diversify their risk, right? Because there are some risks that are implicit to USDC that are not implicit to USDT, which is about being in the US regulatory environment, right? So there might be more fear that Tether is unbacked, but there might be more regulatory fear of USDC getting frozen at some point. So I think there's a natural balancing point between the two, and it forms a little bit of like a duopoly. Maybe there's a room for a third, but it forms, at least for now, kind of a duopoly. And there's some natural balancing point. It may not be 50-50, maybe it could be 60-40 or 40-60 or any ratio, but there's a natural equilibrium for that in which they both survive and do fairly well. And that's basically where I think things are going to go. And I think that on the topic of having a decentralized kind of stablecoin, another alternative is just to have many different kinds of centralized stablecoins. By the time you have hundreds of, USDC type stablecoins and located in all various jurisdictions across the world, every country has their own version of Tether or USDC. Well, then at that point, you can be fairly sure that, that there's some solvency there. Buyers and sellers, they get to pick and choose who they want the issuer to be. There's competition between them. The local governments, they don't always agree with each other. So, not everybody's going to coordinate and freeze everything at once. So you get a little bit of the value of decentralization just from having more of these things too.
Yeah, that's a great point. I guess like the question there or the issue there would be on just like liquidity and volume.
Yes.
Like if you have like a fragmented market, yeah, that's also kind of dangerous and not very useful for big traders, right?
Yeah, I completely agree. So I totally agree with that point. So maybe what I was saying about having 100 just actually doesn't make sense. Maybe it really should just be like 2 or 3 or 4, right? There's some point at which more gives marginal value, and there's some point in which more creates too much stress on the fragmentation, right? So maybe the natural point is like 3 or 4, something like that. But that would still be a good trade-off between safety and liquidity. Concentration of liquidity, right? There's some natural equilibrating point over there too. Yeah.
Liquidation-free, long-term leveraged tokens. That's what's coming fresh out of Tracer DAO's perpetual pools. Deployed on Arbitrum, you can take long or short positions with leverage to trade anything: commodities, crypto, equities, even NFTs. Dive into perpetual pools at tracer.finance. You can also learn more about this release with The Voyage, a week-by-week journey to earn TCR rewards. Head over to tracer.finance today and take a look for yourself. Terra's collapse has caused shockwaves in crypto. Where are those ripple effects being felt the most? Does Kevin see any other projects subject to the same level of risk? And will the real economy be affected at all?
I would say crypto's still too small for that, and thankfully UST didn't get up to $1 trillion in market cap, because then things start really getting affected. So good that it wound down now. I mean, preferably even sooner than now. But yeah, I think I don't see that happening. What I would say is that in terms of contagion, I don't particularly want to cast aspersions on any individual projects. For the most part, if you look at my Twitter, I've only ever said negative things about basically just Luna and UST. For everything else, I try to be diplomatic, within the space, and I understand that there's experiments to be done. And I think, for the most part, I'm even okay with people, building casinos too, because I think a lot of people just like to gamble, and if people want to play their dumb money games, then they should be able to play their dumb money games. I just thought that this one in particular was just too big. So as much as there are projects that I actually particularly don't like, that's just a personal dislike, and I at least respect that some people do like them, and don't want to particularly FUD their bags or anything like that. So to each their own. Hopefully we don't get something as systemic, as bad, as uniquely dangerous as Luna UST, as it is.
Do you see anything else that could potentially match it, or not yet? Like that risk hasn't emerged yet?
No, I would say it hasn't really emerged. What I would say is that if Tether or USDC was actually unbacked, and we're very, there's most of the backing is gone, that would be also extremely devastating. But I put the chances of that happening much, much lower than Luna and UST. I think for Luna and UST, it's just apparent that eventually it's inevitable that this would happen. For the others, it's more opaque, so it's harder to say. It's not an inevitability. Yeah.
Got it. Okay, and then right now, like the market is just a complete bloodbath. Like it's just crazy going to any kind of market tracker. Everything's red. Do you think, are we at the beginning of like a prolonged crypto winter like we saw in 2018, 2019? Or do we bounce back? I mean, there just seems to be so many macro headwinds as well, like playing into this. So it's looking very bleak out there. I'm wondering kind of what your thoughts are.
Yeah, so I have basically two things to say about that. So the first is about crypto specifically, right? So let's say, this was back to, very normalized 0% interest rate policy, back to the good old days of the Fed, but no extra money printing, just a very normalized zero interest rate environment. What I would say is that the timing on the collapse of Luna and UST, and also the devaluing of a lot of these, cryptos and the market caps have come down quite a ways now. And for the most part, we're I think, in a pretty good spot now. Now, that being said, the narrative is so bad and the fear is so bad that that'll take some time to adjust. So at least for now, what I would say is that there'll probably be, I was originally thinking that Luna would blow up later. So I was thinking like 9 months. Now I think maybe like 6 months of just going sideways before a bull market. But that's under normalized kind of macro environment. We're not in a normalized macro environment. And as you can, I'm sure you've seen, the equities and crypto are very highly correlated these days. And there's also a feedback cycle there, because as the correlation is very strong, then basically all these quant shops develop these models showing, hey, look, in the past, correlation's been really strong, so we should run this correlation algo. And their correlation algo, doing the pair trade between equities and crypto, forces the correlation even tighter, right? Which causes the signal to be even stronger for other people to discover, causing them to build correlation algos, so on and so forth, until things get really tightly coupled. And then finally something snaps because they're actually not the same. And then there's a huge decoupling, right? Until that happens, though, I went on a tangent, but until that happens, crypto is still fairly correlated to equities. Maybe this Luna thing is the depegging event or the decoupling event. Unfortunately, it's not as crypto people wanted, and the decoupling upward or decoupled downward. But we'll see if it actually was the decoupling event. But until that happens, I think macro still is the most important thing. I want to just caveat to say that I'm not an expert at macro, so these are just my opinions. But I think basically, given where the CPI is printing, at like 8.5%, real rates are still negative, and Fed basically saying that they're going to maintain the course of doing that double rate hike and then probably another one afterwards, and so on and so forth, and keep going. What I would say is that they have to go a long ways to abate this kind of, core inflation, right? I don't think they make it there. I think at some point they just give up, because generally, if you look at the historical Fed chairmen like, Greenspan, Bernanke, folks like that, there's always like a put right on the market. When the market drops by 20% or 25%, there's enough turmoil that the Fed then steps in and then eases up and becomes dovish, right? This time around, because inflation is so bad, I think politically they would have to wait until like maybe 25, 30% before doing something like that. So 25, 30% drop in the market. And I think so far it's been, just shy of maybe 20%, something like that. So there's a little bit, another 5, 10% to go of a drop in the market before the Fed exercises that put. So I think so they're basically going to keep raising rates, I think, until something like that happens, or something just catastrophically bad breaks in the economy and then they reverse course. But I don't think they make it all the way up to the point at which inflation is actually abated. So what my thought is that, maybe around like 1.5% or like 2% or, something around there, the Fed just kind of, the market's tanked too much, there's too much pain, Fed gives up, reverses course, and then we just slowly die by paper cuts through inflation. Because, whether you die through, the market destroying value or whether you die through just your money inflating away, still at the end of the day, most people prefer, the gentler, approach there. So, and it's more invisible too, so it's easier, to hide it or to obfuscate it or to blame it on, foreign powers or whatever. I mean, I don't know. You just do whatever. They're going to do what they need to do, and they're going to call it the best of names. Mm-hmm. That's what's going to happen, basically. Yeah, that's what I think happens.
That's so interesting. Okay, so you think that the Fed is not going to go through with hiking rates enough to really push inflation down. I mean, maybe they do it until inflation comes down to maybe 2-3%. But by that time, you think that the fallout in the market will be too big, like maybe a 25% drop in equities, that politically it's too difficult for the Fed to actually continue on its course. By that point, they stop hiking rates, and then just, they just let inflation at whatever rate it is at that point.
Yeah. That's basically my thought. Mm-hmm. And I think they're really caught in a hard place because politically inflation is very hard to bear, and politically huge market drops and wiping out of like retirement savings is also hard to bear. So, if they're going to have to choose one of the two, I think they're going to take the easy way out and they're going to choose inflation. That's what my thought is. Yeah.
If that happens, though, it would seem that that's a better outcome for crypto, because narrative-wise, at least, crypto is meant to be a protection against inflation in fiat. So, if we see this kind of situation picking up again where the US dollar is inflating, the crypto investors and advocates can say, okay, go get out of your fiat and buy Bitcoin or buy ETH or whatever.
Yes, I completely agree. I'm extremely bullish on crypto in the long term, and that's also part of the reason that I literally dedicated almost my entire career to crypto.
Do you think this plays out this year, where we start kind of seeing the return of this inflation hedge narrative?
I want to say yes. Yeah. I mean, who knows really, but if I had to guess, I think it would. Yeah.
Check out Oasis Network, one of the fastest growing Layer 1 blockchains. Oasis aims to offer improved privacy and scalability compared to other existing blockchains. They have a $200 million ecosystem fund to help projects build on its network, and it's supported by investors including Terra, Binance Labs, Dragonfly, and Galois Capital. DeFi on Oasis offers close to zero gas fees, high throughput, and has surpassed $250 million in TVL in a few months. Some of Oasis DeFi projects include DEXs like Swap and Gemkeeper, and Fountain Protocol, a cross-chain lending platform. Visit oasisprotocol.org to learn more. Dramatic volatility, like we've seen in the past few weeks, is common in crypto, and the space has gone through bull runs and bear markets throughout its entire lifetime. Like all past bear markets, Kevin believes this one will also be a chance for the space to shake out opportunist and crash grab projects, while the most committed teams stick around to build actually great projects. But there are some key differences, including how interconnected crypto now is thanks to DeFi, and the effect of powerful macro headwinds. So how long and severe does Kevin expect this bear market to be?
Yeah, so I think most of it is actually kind of the same. I've seen 5 cycles already. Every time it's basically the same. At some point there's just too much euphoria, mania. People get greedy. Basically too much capital chases too few good opportunities, right? Because they need to, all the investors need to put the money to work. And as things start working, they get even more capital, even greater in orders of magnitude more capital to deploy. So then supply comes to meet demand, and basically, all these projects start coming up with all sorts of random, crazy ideas, and they can still get funding because the investors need to fund somebody. And then finally, there's a collapse because obviously, if you have just random terrible projects, that's not going to push the space forward. Eventually, the emperor is revealed to have no clothes. The market crashes. Then there's a cycle of digestion as capital dries up, and then finally, during the bottom of the bear market, now you only have true believers who are actually building in the space, and they make really, really good projects. Project quality goes really, really high. Almost nobody wants to fund them because there's no capital sloshing around. But it's actually the best time to invest. But it's when most people are most not interested in investing, and then that builds out and leads into the next bull run. Mm-hmm. So it basically always happens the same way. Now that being said, I think there are maybe a few small differences. What I would say is that in the ICO crash of 2017 to 2018, for the most part, most projects were not as intertangled with each other, right? So you have some good ICOs, you have some bad ICOs. Mostly they were bad, but they failed on their own, and then whoever held it lost money. This time around, because of the advent of DeFi, now everything is supercomposed with each other. Everything is intertangled with each other. There's a lot more systemic risk. So one blow up could start affecting multiple protocols. The token prices of a lot of different tokens start to become correlated with each other because of this intertwining and entanglement. So I would say that's one difference. I would say that I think another difference would be that, things are a lot more mainstream now than they were. And even then, that was more mainstream than 2013. So as more and more people come in, the kinds of things that they want to see and the products that they want to use will start to be very different than what the early adopters wanted to use and what they enjoyed, right? So I think every cycle, in a way, creates new products which blue ocean further out to general, sort of the general population, and the tastes and the fashions and basically the demands of a broader and broader sort of what quote unquote normie audience. And I think that this is a natural course for crypto. I don't think this is a bad thing at all. I mean, this is basically the road to mass adoption, and this is just going to happen. But what I would say is that you would notice the market difference between the types of projects and who they were marketed to, what they do, product design and everything. And you can see that in each of the cycles as it becomes more and more mainstream. The products themselves become flavor-wise more mainstream. And I see that trend continuing through the next cycle, until, it's just fully adopted.
Right. So interesting. I definitely saw this sea change in the past year where crypto finally felt pretty mainstream, or at least not niche anymore. It was something that you could kind of tell anyone on the street and that they will have heard of it, like especially with NFTs. Clubs in Miami were kind of like, distributing them out to, just like regular people, just big brands adopting it to the point where it was like not news anymore. Something that in like 2017, it would have blown people's minds, like Nike selling NFTs. And, like last year was just like, okay, like one more crypto headline. So I agree. Like this cycle was just like spectacular in terms of mainstream adoption. But yeah, maybe we're at this point where there was too much hype and euphoria, and now it's kind of that part of the cycle where things the good projects kind of stick around, the rest kind of go, and I think it's like a healthy shift in the market. For sure.
Yeah, absolutely. We're going through basically a process of digesting misallocated capital.
And in this process, where would investors, like, what's a good place for investors to take cover? I mean, is it like going to the safest stablecoins, earn a little bit of interest, holding Bitcoin and ETH, or like basket of just like blue chip cryptos, or what would you recommend?
I think you just buy whatever you want, really, at the end of the day. Like I don't want to shill long or short any particular coins, because I think that would be a little bit irresponsible. But what I would say is that I'll basically sort of repeat what I heard from Drunkenmiller as he was talking about the stock market. And what he was saying is that he wanted to buy assets which were boring companies, but which had good cash flows and with a lot of pricing power. So, for example, I think he bought into like this door company. They make like doors, right? And very boring business, right? But they have a huge market share. I don't know if they're a full monopoly or they have one of two duopolies. But basically, they have immense pricing power, right? And so they can pass on a lot of the price inflation to the consumer. And then also on top of that, it's not like some 1000x PE multiple, for tech stocks or something like that, right? Its value is not coming from expectations of growth. Its value is coming from a very modest multiple as a discount to the cash flows that it generates, right? So I think that is a a prudent and sound way of thinking about things. I think some people would agree, some people disagree, but I think the reasoning, at least if you believe that paradigm, is sound. And I think in crypto there may be some projects which are more like that, and some projects which are more the opposite of that. Yeah.
So projects with like actual like revenue or protocol fee or whatever you want to call it, actual users and activity happening, sustaining its value, than more just expectations of some other thing being built.
Yeah, and I would say particularly where the revenue eventually goes to the token holders through some kind of buy and burn mechanism or some other type of mechanism, that it goes to them so that they're able to capture the value of it. Now, I don't want to preclude pure governance tokens, because I think there's still an expectation in pure governance tokens that they will at some point be able to vote themselves the fees generated by the protocol, right? So I think there is some still future expectation of cash flows, but I would say that the protocols which derive their value from future expected growth, it's just not a great time maybe for those.
Right. What about staking tokens and like proof of stake protocols? Is that something that you're kind of bullish on?
What I would say is that with proof of stake and with staking, what exactly is going on financially when you stake? So if everybody stakes, then everybody gets the seigniorage, right? And then everybody still has the same share of the network, right? So effectively, then the amount that you get in staking combats the inflation exactly that happens on the supply side. So nominal yields are positive, but real yields are actually zero, right? Now, let's say nobody staked except for one person, right? Then that person collects all of the yield, right? And gets zero inflation. He faces zero inflation because the only inflation he faces is the new money that he gets. He captures all of the seigniorage, right? So then the real yield for him is what the nominal yield is, right? Now, in practice, not everybody's going to stake, and not just one person is going to stake, but it's going to be some mix of the two. And effectively, what is going on here is that you're going to get some kind of real yield between the nominal yield and zero, right? And where does this real yield come from? It comes from the non-stakers. So it's effectively a transfer of value from the stakers or from the non-stakers to the stakers. Now you might ask, why would someone be willing to be a non-staker and just transfer this value and pay all the stakers? Well, because maybe they have other productive uses for the capital not being staked, right? Maybe they have like this yield farming strategy, this trading strategy, or this and that. They have some productive uses for it. So in my opinion, the market basically figures out an equilibrium where some people will stake, some people won't, and both will get exactly what they're looking for. And that's what my thought is on staking and the financial aspect of it.
A super interesting way of looking at it. So I guess like it depends on like the amount of risk that you want to take. Like, do you want that maybe smaller or lower yield from staking, or do you want to use that capital in some other kind of productive protocol or token that might get you a higher return?
Yeah, I mean it's obvious in the extreme case, because if everybody staked and there was no liquid moving supply of this token, then it's like, well, then at the end of the day, the network is not very valuable, right? So the marginal person who can figure out some use of it, can basically benefit greatly, and there's basically an incentive for at least somebody to not be a staker. And then if nobody's a staker, well, then there's an incentive for one person to be the staker, because then they collect all of the seigniorage, right? So the whole thing balances out at some point in the middle, and that was, I guess, the point I was trying to make there. Yeah.
Cool. All right, and then I guess just for an overview of your like position on the market going forward, like are you long crypto at the moment, or just like taking chips off the table? Are you in cash? Like, if you can give like a little like a breakdown of where you stand.
Yeah. One of the reasons that so there's two reasons that I don't want to give my opinion on this. So the first reason is that our fund positions are private, and generally I like to keep it that way. And the second reason is that I don't like the idea of influencers going on podcasts or shows or stuff like that, and shilling things that they're holding, shilling their bags, or shilling their short positions. So I don't want to be in a position where we already have a position on, and then I'm letting people know so that they can come behind me and make my position profitable, right? So I don't want to be in that kind of position where there's that kind of conflict of interest.
Okay, that's totally fair and understandable. It's a great point. All right, okay, and then to wrap up, I'd love to ask you, Kevin, how or what makes you defiant?
Well, what I would say is my hair. I just at some point in my life I just started growing out long, and just nobody left to impress, and just didn't give a fuck anymore. So that's what makes me defiant, I guess. Yeah.
Also, I guess and that does say something about your personality. I think a hairstyle is a reflection of that. So good. This was so interesting, Kevin. Thank you so much for kind of helping me make sense of the past couple of days. I know that we'll kind of look back at this time and have our minds blown at what happened and how much crypto kind of changed from this. I guess we'll still kind of need the dust to settle to take lots of valuable lessons from just what transpired. So thank you so much again for coming on the show. It was a pleasure.
And likewise, it was a pleasure. Thanks for having me.